Most home buyers think they're pre-approved when they're actually not, and that misunderstanding can cost them the house they want. I've seen buyers lose offers, lose deposits, and even lose contracts simply because they didn't understand the difference between a pre-qualification and a real pre-approval. Today, I'm going to break this down clearly so that you know exactly where you stand before you ever make an offer. Hi, my name is Joseph Correa, and I'm a licensed mortgage broker and founder of Finibi Mortgage, and I review borrower files every single day. And one of the biggest misconceptions I see is people believing they're approved when in reality, their information hasn't even been verified. And I'm talking about income, I'm talking about credit and bank statements. Understanding this distinction is one of the most important steps in the entire loan process because the strength of your approval determines how seriously sellers take your offer. Let's get started by defining what most lenders don't clearly explain. Number one, what a pre-qualification really is. Pre-qualification is basically an estimate, okay? Something over the top. It's based usually on information the borrower reports verbally or over the phone or even enters online. Income might not be even used or verified at the beginning. Assets might not be reviewed. Sometimes a lot of people or banks, they just see your credit and they tell you you're approved when that's not the case. Employment might not be confirmed, and sometimes credit isn't even pulled. So this is essentially a rough calculation of what you might qualify for if everything checks out. There's nothing wrong with the pre-qualification. They're useful early in the process when someone just wants a general idea of buying power and how much the payments are going to be and what interest rates ranges at least are at. But the key thing to understand here is that a pre-qualification is not an approval or a pre-approval, okay? We have to be very clear about that. It doesn't guarantee anything. It doesn't mean underwriting has reviewed your file. It doesn't mean the numbers have been validated. It simply means based on what was stated, you could potentially qualify. That's very different from being approved, okay? Now let's talk about number two, what a true pre-approval is. A real pre-approval is a completely different level of review. For a true pre-approval, your lender should verify income documents. I'm talking about your pay stubs, your W-2s, your taxes, whatever it is they ask for or need. Pay stubs, if you have the most recent pay stubs. Credit report, bank statements, employment, debts, assets. If you have more than one house, if you have retirement accounts, if you have other things that can be used or cashed or liquidated so that they are used for the down payment or closing costs. In many cases, your file is also run through what's called an AUS or an automated underwriting system. That system evaluates your financial profile against lending guidelines and returns a decision like approved, approved with conditions, or refer, which means something isn't right there and needs to be reviewed. This is why real pre-approvals are powerful. They're not guesses, they're real verified evaluations. When a seller sees a real pre-approval, they know your financing has already been analyzed seriously. And in a moment, I basically am going to explain why sellers and real estate agents can instantly tell you your approval is weak or strong, even if you can't. Number three, why sellers actually care about pre-approvals. When you submit an offer on a home, you're not just competing on price, you're competing on certainty. From a seller's perspective, the strongest offer isn't always the highest one. It's the offer most likely to close. If a seller sees two offers, one buyer has a verified pre-approval, the other has only a basic pre-qualification, which now you know does not mean much. The seller will almost always choose the stronger file because it reduces their risk if the deal doesn't fall through, okay? And sellers don't want surprises. They don't want any last minute denials. They don't want delays. They want confidence. They want the confidence to know that you have verified approval and that they're not going to sit on that property and not let anybody make any offers for 1 or 2 or 3 months waiting for you to close. And then in the end, it was just a pre-qualification that really didn't have much weight. Pre-approval is the key. Number four, why buyers actually get confused. Most buyers don't misunderstand this because they're careless. They misunderstand because the terminology sounds similar. They think it's the same thing: pre-qualified, pre-approved, approved, conditionally approved, but they're all completely different phases of the entire loan process. And they represent completely different levels of verification as well. Some lenders use the terms loosely, which makes it even more confusing. A borrower might think they're getting a full approval, and the lender has only done a basic review of their file and asked basic questions. They haven't actually seen any documentation. This is why I always tell people, don't focus on the label. Focus on what was actually verified. Ask your lender, did you review my documents? Was my income calculated? Were my assets verified? Was my file run through underwriting? If it's not, then you don't have an approval. Those answers matter far more than the letter that's actually called pre-approval or pre-qualification or whatever name it's given at that moment. Now, let's go over a real loan scenario, okay? Let me give you a real world example of what happens all the time. Buyer receives a pre-qualification online within minutes. They see the pre-qualification, they print it out, they assume they're approved, so they start hunting for houses. They find a home they love, and then they submit an offer and the seller accepts. Then the lender requests documents for the very first time. When the documents are reviewed, turns out income was calculated incorrectly and that the buyer doesn't qualify for the amount they thought. Now the deal is in trouble. The buyer may lose the property and their deposit, or weeks of time, which is a problem for both the buyers and sellers, especially if you're moving from a rental property or selling your other property. And this makes all the difference in the world because you relied on an estimate instead of a verified approval. That's why understanding this is the difference between having a pre-approval and having a pre-qualification means also peace of mind, okay? And you want to be able to have that when you make an offer. Now let's talk about what strong buyers do differently. Strong buyers don't guess where they stand. They verify it. They make sure their documents are reviewed. They confirm their income is calculated correctly. They know their true approval range before making any offer. This gives them confidence. It gives sellers confidence, and it makes the entire transaction much, much smoother. The strongest buyers are the ones who prepare before they shop, not after. And they don't waste the realtor's time and have them driving around looking at properties when they never even qualified, okay? If there's one thing I want you to remember from this video, it's this. A pre-qualification tells you what might happen. A pre-approval tells you what's likely to happen. That difference can determine whether you win or lose the home you actually want. Understanding where you truly stand financially is one of the smartest things you can do before entering the market. If you want to learn how mortgage approvals really work and how professionals actually analyze borrower files step by step, I teach the entire process inside my training programs, and they're in the description. And if you want me to review your specific situation, comment approval below and tell me whether you've been pre-qualified or pre-approved. And I may break down your scenario in a future video.